Yes, today we are going to revise capital structure chapter. Yes. Financial decision, capital structure chapter. So, capital structure has 4 theories in our syllabus. Which 4 theories? Net income approach, traditional approach, net operating income approach, traditional approach, Modigliani Miller approach. So you write down a small summary of this chapter. Capital structure theories. Capital structure theory. So this will summarize the whole chapter. Serial number, particulars, right? Net income approach, net operating income approach, traditional approach, net income approach. Also write down Modigliani and Miller approach, because these two approaches are similar. Modigliani and Miller approach without tax. Draw one full page. If you have the scale, it will be easy for you to understand. First, what is the cost of debt, KD? Cost of debt is constant. Capital structure theories are trying to answer the question whether by changing the capital structure, value of the firm will change. So in the process they are making some assumptions. So as per NI approach, KD will remain constant. As per NOI approach or M&M approach, KD remains constant. As per traditional approach, KD remains constant up to a certain level. Up to a certain level. Thereafter, it increases. Thereafter, it increases. So under traditional approach, cost of debt will also start rising beyond a certain point. Second, write down cost of equity, KE. Cost of equity, write down, remains constant under net income approach, but under net operating income approach increases with the use of more debt. With the use of more debt. In traditional approach, initially K is constant, but starts increasing beyond a certain level of debt. So cost of equity remains constant, but beyond a certain level it starts increasing. So in phase 1 of capital structure, when debt is low, K is constant. Phase 2, when you use more debt, it starts increasing. And phase 3 also, it keeps on increasing, increases at a faster pace, increases at a faster pace. It will increase, but increase at a faster pace now. So point number 3, write down, risk perception of investor. Risk perception of investor. What investor thinks about the risk of the firm. So you will say risk perception of investor in net income approach does not change. Risk perception of the investor does not change. Net operating income approach, equity investors think the risk has increased. Equity investor thinks that the risk has increased with the use of more debt. Equity investor think that the risk has increased with the use of more debt. Is it right? And in the traditional approach, write down, increases for both debt and equity investors. Increases for both debt and equity investors. Increases for both debt and equity investors. So this is third point. Have you noted it down? It's not over. We have to write few more points. Keep writing. At one place you will have the entire chapter in one page. Net income approach, I will just write heading again. Net operating income or M&M approach, traditional approach. Draw the lines. Okay, follow me. Point number 4, write down, what happens to KO or WACC in net income approach decreases with the use of more debt. So if you use more debt, WACC will decrease. What happens to WACC under NOI or M&M approach? Constant. Under NOI approach, WACC remains constant. Traditional approach, phase 1 decreases. Phase 1 low debt. Phase 2 means moderate debt is constant when the proportion of debt is moderate. And phase 3, when debt is very high, then it starts increasing. It starts increasing. Is it right? Point number 5, value of the firm. So what happens to the value of the firm under net income approach increases with the use of more debt. Point number 4 and 5 are same actually. 4 is saying KO decreases, which means value of the firm increases. Under NOI approach and approach without tax, when there is no tax, value of the firm remains constant. And what happens in traditional phase? Phase 1, value of the firm will increase. Exactly reverse of the fourth number point, value of the firm remains constant in phase 2, and in phase 3 the value of the firm will start decreasing. If you use more debt, KO will rise. If KO will rise, value of the firm will fall. Is it right? Point 6, formula for value of firm. In net income approach, value of firm will be equal to, you first find value of equity and plus value of debt. Value of firm is equal to value of equity plus value of debt. In NOI approach, value of firm is equal to EBIT upon KO. EBIT upon KO. And in traditional approach also, usually will follow this method. First we will find value of equity and we will add value of debt. Got it? Then how do you get value of equity? In net income approach, usually what we do, we take earning before tax divided by cost of equity to get the value of equity. In case of NOI or M&M approach, value of equity is equal to balancing figure is value of firm minus value of debt. And in traditional approach also, it is EBT upon KE. So usually these are the steps we follow. And how do you get value of debt? Value of debt will be interest upon cost of debt. Interest upon cost of debt, usually given in the problem only. Value of debt is usually given in the problem. If not given, interest upon cost of debt. If not given, you can try yourself. Okay, done. Are you writing nicely? So one day before the exam you can use it for revision purpose. Point number 9, write down. Does capital structure matter? Does capital structure matter? That is, influences value of firm? Does capital structure influences the value of firm? So the answer as per net income approach is yes. Capital structure influences the value of the firm. In NOI approach, Modigliani-Miller approach, if there are no taxes, then capital structure does not influence the value of the firm. And under traditional approach, the answer is yes. Capital structure influences the value of the firm. 10th point, write down. What is the optimum capital structure? What is the optimum capital structure? So, in the under net income approach, the answer is maximum use of debt. Maximum use of debt. Okay. If possible, use 100% debt. If possible, use 100% or whatever maximum debt is possible, you will use to maximize the value of the firm. Here, no capital structure is optimum. Or every capital structure is optimum. Or every capital structure is optimum. In traditional approach, optimum capital structure is phase 2 capital structure. Is phase 2 capital structure. That means they should stop at phase 2. Is it right? Point number A, cost of equity. How to calculate cost of equity? So, cost of equity equal to EBT upon value of equity. Here, EBT upon value of equity or K is equal to KO plus KO minus KD into debt upon equity. This is Modigliani-Miller formula. In last column also same thing, EBT upon value of equity. And how will you calculate overall cost of capital? KO. So, KO will be equal to EBIT upon value of firm under net income approach. We are revising the chapter capital structure. Okay. Here also same, or you can also find out KO by weight of debt into cost of debt plus weight of equity into, same formula applicable in all approaches. same formula applicable in all approaches. Either you can use weighted average cost of capital or EBIT upon value of the firm. Have you written 12 points? Is it a good summary of this chapter? One more point. 13 number point, write down diagram. How will the diagram look like? Net income approach, KD is constant, K is constant, KO will fall. Net income approach. Net operating income approach, KD is constant, K will rise with the use of more debt. On the x axis we have debt equity and on y axis we have cost. KO will remain constant here. Do you remember anything like this? Have you studied like this? Yes. And in traditional approach, so there are 3 phases. Phase 1, phase 2, phase 3. You have debt equity ratio here. Okay. So debt will remain constant, KD. Phase 1, K will also remain constant. So KO will fall. This will look like net income approach, first phase. Okay. Phase 2, KD is still constant. K will rise. KO will become constant. Phase 3, KD will rise, K will rise. So this will also start rising. So phase 2 is the optimum capital structure. Phase 2 is the optimum capital structure. Is it right? So close this chart now. Now we'll write next heading, Modigliani and Miller approach in bracket and net operating income approach with tax. With tax. So here first we'll find value of unlevered firm, VU is equal to EBIT upon KO or KE, right? KO or KE will be same for unlevered firm. Unlevered firm does not use debt, 100% equity firm. Then what you will do? You will find value of levered firm, that is VL, will be equal to value of unlevered firm plus debt into tax rate, that is the present value of taxable on interest. Okay, where debt into tax rate is present value of tax shield on interest. Present value of tax shield on interest. Third, write down. Then they will ask you value of equity of unlevered firm. Levered firm. Value of equity of levered firm. In case of unlevered firm, value of equity and value of firm are equal. So, value of equity of levered firm will be value of firm minus value of debt. Value of firm minus is value of equity of levered firm. What about value of equity of unlevered firm? Same. Equity and firm has same value if there is no debt. KO and KE are equal. Value of firm and value of equity are equal for unlevered firm. Up to this you have noted. Point 4, write down. Cost of equity of levered firm will be earning after tax upon value of equity. Earning after tax upon value of equity. Then write down overall cost of capital is equal to EBIT into 1 minus T upon value of firm. Right? Or KO is equal to WD into KD plus WE, weight of equity, into cost of equity, where cost of debt will be interest into 1 minus tax rate. Interest into 1 minus tax rate. Interest into 1 minus tax rate. Note, for unlevered firm, point 1, KO is equal to KE, value of firm is equal to value of equity. Right? Then we have seen some more formulae. So these are the formulae relating to capital structure theories. Next formula is for financial break-even point. Write down next heading. Financial break-even point. Financial break-even point is that level of EBIT at which EPS is equal to 0. That level of EBIT at which EPS is equal to 0. And the formula is financial break-even point equal to, who will give me the formula? Interest plus preference dividend divided by 1 minus tax rate. You need to earn so much EBIT so that you can pay interest and preference dividend. Okay. So that they will ask you in some question. Next we have seen one more formula, EPS in difference point. EPS in difference point. So write down next heading, EPS in difference point. 1 second. First you note down this much. Write in good handwriting. One day you have to read also. Write down EPS in difference point. First, what is EPS in difference point? It is that level of EBIT at which EPS under two financing plans are equal. It is that level of EBIT at which EPS under two financing plans are equal. It is also called EPS equivalency point. EPS equivalency point. So how do we solve? We'll write an equation and solve. EBIT minus interest into 1 minus tax rate minus preference dividend 1, even interest 1, that is EPS under first plan, divide by number of share N1. Second plan, EBIT minus interest 2 into 1 minus tax rate minus PD2 divide by N2. N1, N2 means number of equity share. This means number of equity shares. Already we have covered in our regular lectures number of equity shares under plan 2.
Yes, sir.
Now in some question preference dividend may not be there, write 0. In some question interest may not be there, write 0. So what you have to do, according to question, you have to change the formula. If a formula has only equity, then EBIT into 1 minus T. If it has equity plus debt, EBIT minus interest into 1 minus T. If it has all the three, equity, debt, preference, EBIT minus interest into 1 minus T minus preference dividend. Is it right? What you have to do after writing this, solve the equation and find EBIT. The diagram for this will be this is plan 1, this is plan 2, this is EBIT on x axis, EPS on y axis. So this is your EPS in difference point, where EPS under plan 1 and plan 2 are equal. Okay. Below this point, plan 1 will have higher EPS, above this point, in our example, plant 2 will have higher EPS. So when they ask you to write a theory question, it is better to draw the diagram. Is it right? Now we'll solve some questions. So you can just revise it a day before the exam. All the formula we have covered in this. So please come to question number. Check what is this question number, November 2022 exam for 4 marks. Question number 45. November 22 exam for 4 marks. Are you ready? The following are the cost and values of the firm A and B according to traditional approach. According to which approach? Traditional approach. Traditional approach means the overall cost of capital and value of the firm can change by using a proper capital structure in phase 2. That was traditional approach. So what data they have given, accordingly we have to solve. Total value of the firm V is given 50,000, 60,000. Market value of debt D is given in rupees. Question number 45 in the book, 0 and 30,000. Market value of equity. Now how they have got market value of equity? Value of the firm minus value of debt. 50,000 and 30,000. Even if this was not given, you could have calculated this, yes or no, but your institute is very kind. Now they have given expected net operating income. Net operating income means EBIT. Net operating income means EBIT is 5,000 rupees. Cost of debt in rupees means interest. So what it means is basically interest. If it is given in percentage, then it is different. It is rate of interest. If it is given in amount, it is interest. So 0 because there is no debt in the first column, and 1800 they have calculated themselves. Now next is net income. Net income means EBIT minus interest or EBT. So they have, see, they are so kind. They have done the calculation for you. 5,000 minus 0 is 5,000. 5,000 minus 1800 is equal to 3,200. Now they have written cost of equity K is equal to net income upon V. What is the mistake here? I have written a mistake here. Cost of equity is net income upon value of equity. So it should be NI upon E. Should be NI upon E. But what they have written? NI upon V. So that's a wrong formula, wrong use of letter here. Anyway, you can just try, is it matching or not? 5,000, no, it is matching. Calculation is matching, formula is wrong. 5,000 divided by 50,000, how much? 10%. Then take on your calculator 3,200 divided by this 30,000. 10.66. So they have rounded off in 2 digits, 10.7%. Okay. So anyway, don't bother. Only this letter V should have been E. Okay. Let us go ahead. Most of the calculation they have done. Compute the equilibrium value for firm A and firm B in accordance with approach. Equilibrium value means market value of the two firms you have to find out. You have to find out the market value of the two firms. Okay. Assuming that taxes do not exist. So this is M&M approach without taxation. Enjoy, no taxation. and the equilibrium value of KE is 9.09%. Compute the value of equity and cost of equity for both the firms. Again, one mistake. They are saying equilibrium value of K is 9.09%. Then why they are asking calculate the cost of equity for both the firms? So it is appearing that this K should have been KO. That means the overall cost of capital is KO. Then we can do reverse working and find out first the value of firm minus value of equity. Then you will be able to compute the cost of equity. Is it right? So we will write few notes about this question. First is this is one small mistake here. Second, this should have been KO, because if it is KE here, then there is no need to ask this question. Find out the cost of equity for both the firms. The two firms can have same KO. The two firms can have same KO, but they cannot have same KE because firm A is not using debt and firm B is using debt. So KE of firm B would be higher than firm A because firm B is a levered firm. So one is unlevered firm, one is levered firm. And since there is no taxation, the calculation would be very simple. So write down some notes. Interested candidates will write some note. In the question, it is given right, so that you will understand also. Writing makes you more understandable. Okay, if you only just keep watching, it becomes like some kirtan or bhajan is happening here, or you have come into satsang and nothing happens after you go home. You are back to the same person, but you have to participate. So in the given question, K is equal to Ni by V, it should be Ni by E. It should be Ni by E. Do you agree? Second note, write down. It is given that equilibrium value of K is equal to 9.09%. It is given equilibrium value of K is equal to 9.09%. It should be KO. It should be KO. Otherwise, there is no need to. Ask cost of equity. In part 2 of the question. There is no need to ask cost of equity in part 2 of the question. Third line, write down. Under M&M approach, write little fast. Where taxes do not exist, the value of the two firms are equal. And overall cost of capital is also equal. The value of the two firms are equal and overall cost of capital is also equal. KO are equal, value of the two firms are equal if they belong to same line of business. So now you write down next line. where we will solve, they have asked to find out the value of the equity, cost of equity for both the firms, right? Under which approach? M&M approach. The given data is as per traditional approach. The given data is as per traditional approach. But you have to solve the same problem under M&M approach. That is the beauty of this question. Given data is for traditional approach, but you have to assume now M&M approach and see what will happen. So please write a very good question, subject to some minor error in the drafting of the question. Calculation of value of the firm, value of equity and cost of equity of both the firms under M&M approach, right? Under M&M approach. Under M&M approach. Are you ready? Say yes, we are ready. Yes, we are ready. So first you start with EBIT. Look at the question. EBIT of both the firms. In your question book, come on, EBIT of both the firms. How much? 5,000 each. 5,000. Point number B, write down cost of capital. Cost of capital. How much is cost of capital? KO. We have written a note that this 9.09% which they have given to us, we will treat it as a KO, not KE. So cost of capital is 9.09%. We have written a note also that under MM approach, both the firms will have same value and same KO if there is no taxation. Point number C. Value of the firm. Yes, come on, EBIT and cost of capital is given to you. So can you please tell me what will be the value of the firm? Multiply or divide? A by B or A into B? A by B. Sorry. A by B. Take on your Chinese calculator. 5,000 divided by 9.09%. So both the firms value will be same, 55,006. Are you getting? Now what should we do to get the value of equity? We should deduct the value of debt. Deduct the value of debt. Deduct the value of debt 0 and 30,000. 0 and 30,000. Okay. Then write down value of equity. C minus D. Come on. Who will reply? Value of equity under M&M approach. 55,006 and 25,006. Are you getting? What is the next point we will write? Interest. How much is the interest given to you? Interest is given in the problem. Please search. 0 and 1800. So then write down EBT, A minus F. EBT is A minus F. EBIT is 5,000. Interest is first column 0. So EBT will be 5,000 and 5,000 minus 1800. 3,200, right? 3,200. 3,200 is right. $3,200 is right. So now this answer is over value of equity. How will you get cost of equity? EBT divide by value of equity. So write down cost of equity equal to, one more time write down the formula, EBT upon value of equity. EBT upon value of equity 9.09%. Check. You will get the same result because there is no debt. And second column 12.8%. 12.8% is right. Write down below. Alternatively, for firm B, KE can be calculated as follows. Alternatively, for firm B, KE can be calculated as follows. Do you remember the formula for cost of equity as per M&M? So write down as per M&M, K is equal to KO plus KO minus KD into debt upon equity. So I'll give you the value, you will solve, keep the firm B in front of you in your answer. KO 9.09. What is the cost of debt in this problem? Cost of debt in percentage. How much is the how much is the rate of interest in this problem? Can you just look at the question and give me the rate of interest? Where is the rate of interest? Where is the rate of interest? You are a student of finance. How much is the interest amount given in the problem? How much is the value of debt given in the problem? 30,000. 6%. So this you will write later as a working note. So first you write down 9.09 plus 9.09 minus 6 into 30,000 divided by 25,006. So that comes to 12.8%. Is it tallying with your tabular format answer? Right. So both way you can solve cost of equity of a levered firm. Either you can take EBT upon value of equity, or you can apply the formula. You will get same answer. And the rate of interest in the question is 1800 rupees the amount of interest and 30,000 is the value of debt. So are we getting 6%? Yes. Now we'll come to one question number 7 in your book. Requesting you to please come to question number 7. Find question number 7 and come wherever it is. Find question number 7 and come. In your book, a very comprehensive book given to you. We will take all important questions today so that your chapter will get revised. And few questions which if we are not able to take in the class, similar question you can do as homework also. So are you there? Question number 7, are you there? See the importance of this question first. Study material, October 2021 MTP 5 marks, April 2020 MTP for 5 marks. Following data is available in respect of two companies having same business risk. If they have same business risk and if there is no taxation, the values will also be same, KO will also be same. Capital employed is 2 lakh, EBIT is 30,000 and cost of equity is 12.5%. Now they are saying these are the two firms, levered firm, unlevered firm. Debt 1 lakh, equity 1 lakh, in unlevered firm 2 lakh and debt borrowing rate is 10% given here. Investor is holding 15% share in levered company. Calculate the increase in annual earning of the investor if he switches his holding from levered firm to unlevered firm. If he switches his holding from levered firm to unlevered firm. Okay. So right, first we will find out the value of the firm. So this is a question under which approach? Modigliani and Miller approach. Question is not complete. They should have mentioned here under M&M approach. Right. As per M&M approach, if the two firms are similar in all aspects except their capital structure, their values must be same. If their values are not same, then investor will substitute corporate leverage for personal leverage. They can borrow at the same rate at which the company borrows, and they will borrow in the same ratio and which the company borrows, and therefore by buying sale of undervalued company and selling shares of overvalued company, they will be able to make extra gain, and that is what we have to prove here. If one person does it, more people will do the same exercise. When more and more people make arbitrage profit, the value of the two firms will be equal. The one which is overvalued, its price will fall. The one which is undervalued, its price will rise. So now you first write down calculation of value of two firms. Step 1. Calculation of, this is another typical exam question where you have to apply the arbitrage principle and show how will you shift from overvalued company to undervalued company and how much additional profit you are going to earn. So which are these two firms? Levered firm, unlevered firm. We will take today some of the most important and likely questions for exam purpose. Okay. So write down first point A, write down EBIT. Check EBIT in the first paragraph. Both firms have rupees 30,000 EBIT. Keep writing along with me or you will be left behind. Less interest. First company has interest 1 lakh into 10%. Question in front of you. Today you will revise the whole chapter again. 10,000 in the first column. Point C, write down EBT 20,000, 30,000. Point number D, cost of equity. Now this question has a small area of doubt. Cost of equity they have given only once, 12.5%. They have not clarified is it for levered firm or is it for unlevered firm. So what we will do, we will assume it is for both. On your own you can't assume anything, is it right? So better you take 12.5% for both. So what will be the next line? Value of equity. Value of equity is equal to EBT upon KE. EBT upon KE if there is no tax. Please solve. 20,000 divided by 12.5% is 1,60,000. 30,000 divided by 12.5% is 2,40,000. Point number F, value of debt. Value of debt in levered company is 1 lakh. Unlevered company 0. Point number G, write down value of firm. Value of firm is E plus F. 2,60,000. 2,40,000. So I'll just write a remark here. Which is overvalued firm? Levered firm, overvalued. Which is undervalued firm? Unlevered. So under Modiglian and Miller approach, first we have to identify which is the overvalued firm. You will sell shares of overvalued firm and buy shares of unlevered firm and also borrow money. Is it right? and also borrow money. So right in the question they have given you one small hint. An investor is holding 15% share in levered company. Calculate increase in annual earning if the investor switches his holding from levered firm to unlevered firm. Okay. So write down step number 2. The investor, step 2, write down the investor will sell. The investor will sell the investor will sell 15% shares in levered company. So what is the amount realized? How much cash he will get by selling? 15% into, come on, this is the value of equity of levered firm, 1,60,000. Suppose you are holding 15% stake in this company, so you can sell it for 15% of 1,60,000. Anybody, how much is that? Is it 24,000? 24,000. Step 3. The investor will borrow. The investor will borrow proportionate amount. Investor will borrow proportionate amount to maintain the level of risk. The investor will borrow proportionate amount to maintain the level of risk. So now you understand, this is the difficult part of this chapter. Equity is 1,60,000 against which we have 24,000. Firm has a debt of 1 lakh. So how much amount will the investor borrow so that investor will have the same debt equity ratio? How much amount investor will borrow? Anybody? Amount to be borrowed. Yes, you are not replying. We have already done in the regular batch similar questions, or you must have done. Amount to be borrowed is equal to, so I will tell you once again. In case of company, equity is 1,60,000, loan is 1 lakh. Equity versus loan. So in case of investor, his own fund is 24,000. So how much should be the loan in his account? Proportionate amount. Or anybody? Yes, please reply. If you don't reply, I will not teach only. How will I go ahead if you can't solve arithmetic? Then amount to be borrowed is equal to 15,000. Either you write this if this is understandable, or very simply just take 15% he has equity, so he will take 15% of debt. That is 15% of same percentage multiplied by amount of debt 1 lakh, so 15,000. At what rate he will borrow? At the same rate at which the firm has borrowed, at the rate 10% per annum interest. He will borrow in his personal capacity. He will maintain the same debt equity ratio in his individual capacity which the firm is maintaining, and he will borrow at the same rate, because if he borrows at a higher rate he will not be able to earn additional profit, and if he does not maintain in that same proportion, again he may not be able to earn the additional profit. So now the question was, how much would be the additional income. Step number 4, write down first. Step number 4, total amount available for investment. Total amount available for investment in unlevered firm. Total amount available for investment in unlevered firm will be own fund 24,000, borrowed fund 15,000, equal to rupees 39,000. So he will put 39,000 in unlevered firm. He has his own money 24,000. He borrowed 15,000. So now he will invest 39,000 in unlevered company. Last step 5, write down. Calculation of increase in annual earning. Please try calculation of increase in annual earning. Earlier he was holding shares in levered company. Now he is holding shares in unlevered firm. First chance to you. You must have done this question before. How much additional earning he will have by switching from levered firm to unlevered firm? First chance to whom? To the student. Why? Because he is intelligent and we are revising. So you should also get chance. So let us write down first EBT of the firm. How much is EBT as per step 1? As per step 1, 20,000 and so this is the earning of the company. EBT of the firms. And then you write point B, net income of the investor. How much investor will earn in these two companies? So first point A, dividend income. Investor is holding 15% in the levered firm. So if he remains in levered firm, he will enjoy 15% of 20,000. That is 3,000. So earlier he was getting a dividend income of 3,000. How much he will get now? Now he has purchased, on the screen, pay attention, 39,000 rupees divided by 2,40,000. So his stake in the company is not 15%. It is 39,000 out of 2,40,000. 39,000 total valuation is 2,40,000 into the share in the earning 30,000. So he will get 4,875. But in unlevered firm, to invest the money in unlevered firm, he has borrowed money. So what I'll do? Less interest on borrowing. Less interest on borrowing. How much amount he has borrowed?
15,000.
At what rate he has borrowed? 10%. So in the second firm, he has to pay 1,500 rupees interest. So what is the net earning? Yeah, net income. Small a minus small b. Here it is 3,000. It is 3,375. Very good. So earlier he was earning 3,000 by switching from one company to another company by borrowing some money in certain ratio and at certain rate, is getting 3,375 more. Therefore, your question was increase in annual earnings. Write down. Therefore, according to question, write the heading. How much additional earning he will have? 3,375 minus 3,000. 375. 375. Is it right? This answer is over. Any query on this question? This is second type of question where they will ask you to show the shift from one form to another form. Now we'll go to one question number 23. Please come to question number 23. In your book you will find question number 23. Very important question. This question was asked in May 18 May 18 RTP, and also write it is a past exam question. Past exam question. They have asked in past, before 2018, under old syllabus. Okay. Company P and Q are identical in all respect, including risk factor, except for debt equity. So their debt equity ratio is different. Company P have issued 10% debenture of 18 lakh, while company Q unlevered, means there is no debt. Q is unlevered, P is levered. Both the companies earn 20% before interest and tax on their total asset of 30 lakh. So my question to intelligent student is, what is the EBIT of these two companies? Both companies earn 20% before interest and tax, means EBIT, on their total asset of rupees 30 lakh. 6 lakh, 20% into 30 lakh. 6 lakh is the EBIT. So this time EBIT is not directly given to you, but you will have to do some efforts, calculation. So EBIT is 6 lakh. Assume tax rate is 50%. So now we are solving a question with taxation. First two question I solved without taxation. And capitalization rate of 15% from an all equity company. It means KE of unlevered firm is equal to 15%, which is also equal to KO of unlevered firm, which is also equal to K of unlevered firm. Is it right? Then compute the value of the firm P and Q using net income approach and using net operating income approach. So when there is a taxation, how do we solve? Under net income approach and under net operating income approach. So right, first we will solve under net income approach. Same method we have already used. Write down calculation of value of two companies. Step 1, for heading, write down first heading, calculation of value of two companies under net income approach. So this question was asked in exam some years ago for 6 marks. And this is when you have taxation, in bracket with taxation. With taxation, net income approach with taxation. Right hand side, P limited, Q limited. P is a levered firm, Q is an unlevered firm. Please practice in writing. More practice in writing, more comfort you will get, more confidence you will get. You will be able to present in the exam also. Reading the answer is not enough. Practicing the answer is required. And you have to practice only. Full answer you have to practice. So first you write down EBIT. EBIT is 20% into 30 lakhs. Is it 6 lakh? 6 lakh. What is my next point? I will deduct interest. To get the value of the firm, I will have to find value of equity plus value of debt. Is it right? Which firm will pay interest? P. How much? 10% of 18 lakhs is 1 lakh 80,000. Point C, EBT A minus B 4,20,000 and 6 lakh, correct? So what you have to do, the only thing you have to do now, if you have taxation, then under net income approach, you have to first deduct tax also, less tax at the rate of 50%, 2,10,000, 3 lakh. Point E, write down earning after tax is right. How much? Same, 2,10,000, 3 lakh. So point number F will be cost of equity 15%. 15%. Why we have taken 15% in both? So you are aware that under net income approach, K is constant. K is constant. I have given you a chart today where you can see under net income approach, which approach? Net income. K is constant. If K is constant, it means it is 15% for both. Right. Point number next. Value of equity. E divided by F. 2,10,000 divided by 15% is 14 lakh. 3 lakh divided by 15% is 20 lakh. Next point is add value of debt. Here it is 18 lakh, first column, second 0. There is no debt. Therefore, value of firm G plus H 32 lakh, and so this is your first answer. You will get 2 or 3 marks for this much effort. Now suppose if there is no taxation, what we do? For same question, if there is no taxation, this line you will remove, this line you will remove. Okay, if there is no tax, don't do anything. Without taxation, EBT divided by K, value of equity plus value of debt is value of firm, net income approach. And with taxation, deduct tax, get EAT, then value of equity. So there is no major difference between the approach of solving. Now, answer is not over. Second part of the question is find the value of the two firms using net operating income approach. Under net operating income approach, always first calculate the value of unlevered firm. Value of levered firm is more than value of unlevered firm. to the extent of present value of tax shield. Okay, so write down point 2. You have to practice so many approaches, so many situation. Value of two firms under NOI approach bracket with tax. The chart that I had given you was without tax. Is it right? But if there is taxation, then what we do? We solve in 2 steps. Step 1, value of unlevered firm we will calculate first. Which is the unlevered firm in this example? Q. So write down value of Q limited is EBIT upon KO. EBIT 6 lakh is right. And how much is KO in the problem? 15%. It is written here on the screen. On the screen, capitalization rate of 15% from an all equity company. So this is KO of an unlevered firm. 15%. So tell me 6 lakh just wait a minute, because there is taxation, it is 1 minus T also. Yes, 1 minus T. There is taxation also. Is it 20 lakh? EBIT into 1 minus T if there is taxation. If there is no taxation, EBIT by KO. Okay. Are you getting 20 lakh?
Yes, sir.
Step 2. Step 2 will be value of levered firm. Which is the levered firm? P Limited. Is it right? So, do you remember the formula for levered firm when there is taxation is equal to value of unlevered firm. Value of unlevered firm, but value of a levered firm is more than unlevered firm to the extent of present value of tax shield on interest, which is equal to debt into tax rate. This debt into tax rate is the present value of tax shield on interest that I have given you today in the summary. So value of the unlevered firm already calculated above 20 lakh. Same figure. This figure you have to copy here. What is the debt? 18 lakh. And what is the tax rate? 50%. So the answer will be rupees 29 lakh. The answer is rupees 29 lakh. Do you agree? Say yes. We agree. This is 6-mark question. Only this much effort you have to take. Okay, now we'll take one more important question. 31. Another variety of question. So today is variety. Are you ready?
Yes, sir.
Question number 31. A and B are identical in every respect except capital structure. A Limited does not employ debt in the capital structure, whereas B Limited employs 12% debenture amounting to rupees 100 lakh. So tell me, which is the levered firm in this example? B Limited is levered firm. Which is unlevered firm? A Limited. Wonderful. Assuming all assumptions of M&M model are met. Tax rate is also given, so we have to solve the problem with taxation like the one we did previously. 30%. EBIT is rupees 25 lakh. Equity capitalization rate of A Limited is 20%, and A Limited is an unlevered firm. A Limited is an unlevered firm. So this is the question of M&M approach with taxation. So first we will value A Limited, then we'll value B Limited, which is an unlevered firm, by applying the same formula. Which formula? This formula on the screen. Value of a levered firm is equal to value of unlevered firm plus debt into tax rate. After that, what they have asked, calculate the value of both the companies and also find out the weighted average cost of capital for both the companies. October 19 MTP 5 marks, April 21 MTP 5 marks. Which company we should value first? Unlevered firm, right? Which is unlevered firm? A Limited. So first write down calculation of value of unlevered firm A Limited under M&M approach. Under M&M approach. So what is given? Cost of equity is given 20%. KO will also be equal to 20%. Why? Since it is unlevered firm. No debt. If there is no debt, then KO is equal to KE. Okay. Then write down value of firm or value of equity, because both have same KE and KO. So value of firm and value of equity both will be same. Is it right? So you write down EBIT if there is taxation into 1 minus T upon KO. If there is taxation, then you have to multiply by 1 minus T. EBIT, just check, is it given in the problem? 25 lakh. Into tax rate, is it given in the question?
Yes, sir.
30%? 30%. And KO we have written above 20%. So would you be kind enough to reply 25 lakh into 0.7, 87 lakh 50,000 is the value of equity or value of firm A Limited? Both are equal.
Oh,
Both are equal because there is no debt. There is no debt. Whatever is the value of equity is the value of the firm. So this will be using in the next answer. Now 87 lakh 50,000. Next heading, write down point number 2. Value of levered firm B Limited as per M&M approach. As per M&M approach. Okay. So write down is equal to value of unlevered firm plus, come on, debt into tax rate. 87 lakh 50,000 plus how much is the debt in case of this firm? You can see 100 lakh there. And how much is the tax rate? 30%. So that comes to 1 crore 17 lakh 50,000. Then they have asked you one more question. Weighted average cost of capital for both the companies. For A Limited, we have already answered 20%. 20% is the WACC for A. For B, write down WACC for B Limited will be EBIT into 1 minus T upon value of firm. Is right? So EBIT was how much? 25 lakh. Write down into 1 minus 0.3. Value of firm we have got just now, 1 crore 17 lakh 50,000 into 100. Yes. $14.9. 14.9%. 14.9%. They have not asked you, but if they ask you value of equity, then what will you do? This is extra. Value of firm minus value of debt. So 1 crore 17 lakh 50,000 and debt is how much? 100 lakh. So this will be 17 lakh. This way you can find the value of equity. Is right. So sometimes they ask you value of equity also. So you can do it like this. Question number 24. Please come to question number 24. November 18 RTB and May 2020 exam for 5 marks. Oh my God, 5 marks. Either MTP or exam. Ronak Limited is an all equity finance company with a market value of rupees 25 lakh and the cost of equity is 21%. So all equity finance company means unlevered company. Market value of firm means market value of equity also. And cost of equity means overall cost of capital also. So KO and KE are 21%. Value of equity and value of firm both are 25 lakh. Company wants to buy back equity shares worth rupees 5 lakh by issuing and raising 15% perpetual debt of the same amount. So what they want to do? They want to reduce equity and in place of that they want to use debt which will carry interest at the rate of 15%. Rate of tax may be taken as 30%. After the capital restructuring means after equity is reduced and debt of rupees 5 lakh is introduced and applying model with taxation, you are required to compute market value of J, cost of equity and WACC using market value weights and comment on it. Similar to previous question, First, what I'll do, first we will find out the value of Ronak Limited when it was an unlevered firm. Now it has become a levered firm. So when you become a levered firm, the value will go up. How much it will go up? To the extent of present value of tax shield on interest. And the present value of tax shield on interest is debt multiplied by tax rate. So once you do it, you will get the value of this company. From that you deduct value of debt, you will get market value of equity. Yes or no? Market value of the firm minus debt is market value of equity. Cost of equity will be earning after tax upon market value of equity. And weighted average cost of capital, just now we have done EBIT into 1 minus T upon value of the firm. All basic formulae they are testing. Is it right? I have seen in my experience very few students are able to solve such questions. You may find it repeated, boring, but in the exam hall, very few students are able to exactly understand what I have to do, which formula to be used. So when they are saying M&A approach with tax, first thing unlevered firm value, second thing levered firm value, minus that value of equity. EAT upon value of equity is cost of equity. EBIT into 1 minus T upon value of the firm is overall cost of capital of the firm. So let us practice one more time. So write down calculation of value of Ronak Limited. Calculation of value of Ronak Limited. Keep writing. First point, value of Ronak when it was unlevered firm. When it was unlevered firm. So value of the firm is equal to EBIT into 1 minus T upon KO. So value of the firm is given to you 25 lakh. So we can find actually EBIT in this process. EBIT is missing. What is the tax rate in this question? 0.3. This time reverse question. KO is given 21%. 0.21. 0.21. So EBIT is 7,50,000. We'll just make a small change in heading. Calculation of EBIT, instead of value, write on EBIT of Ronak Limited. Calculation of EBIT of Ronak Limited when it was unlevered firm. Because value of firm is given. Okay. Now write on to value of Ronak Limited after restructuring. After restructuring means on becoming levered firm. On becoming levered firm. So value of levered firm is equal to value of unlevered firm plus in bracket debt into tax rate. Debt into tax rate. So that value of unlevered firm 25 lakh is already given in question. Debt will be 5 lakh after restructuring and the tax rate is 30%. So the final answer would be 26 lakh 50,000. Is it right? So my first question was what will be the value of J Limited after restructuring? This is 26 lakh 50,000. Okay. Now the next question is what will be the cost of equity? So for that first I will find out value of equity. Value of equity formula is value of firm minus value of debt. So you will say value of firm is 26 lakh 50,000 minus 5 lakh is 21 lakh 50,000. Follow the process. Okay. So now tell me, in order to get cost of equity, what will I do? What do I need?
Cost of equity and value of equity.
Cost of equity I have to find. So I need earning after tax upon value of equity. And to reach earning after tax, I have already calculated EBIT. Okay. So step number 3 write down, which is your question number Roman 2. Calculation of cost of equity. See, with practice you will understand. Okay, I can understand that it may be confusing, but with practice you will be able to get the answer. Otherwise this chapter many students leave, many teachers also leave. Okay, they also get confused, but there is nothing to be getting confused. If there is taxation, follow the principle. First find unlevered firm, then find levered firm, then find value of equity, then find cost of equity, which will be earning after tax divided by value of equity. EBIT. How much is EBIT? 7,50,000. Point B, less interest.
So interest is 1 lakh.
5 lakh is the debt and rate is how much? 15%. So you should write calculation also, because later on should not be confusion. So you get EBT 6,75,000. Point D, less tax at the rate of 30%. Tax at the rate of 30%. So how much is the taxation? 30% is 2,02,500. So you will get earning after tax. This is the earning available to equity shareholder, 472,500. Do you agree? This is the income and this is the value. So don't you think that if this is the income and this is the value, I can get KE now?
EBT upon value.
So point number F, write down value of equity. Go to previous step. Step 2.
21 lakh 50,000.
21 lakh
50,000.
50,000. So therefore, cost of equity
21.9.
E by F 21.98% approx, write down if you are rounding off. And this was your second question. Third question, WACC. So right, next step 4, WACC is EBIT into 1 minus T upon value of firm. upon value of firm. Numerator and denominator should be consistent. When you are computing cost of equity, we take earning after tax upon value of equity. When you are computing for the entire firm, WACC, EBIT into 1 minus T upon value of the firm. Okay, right. What is EBIT? 7,50,000. What is tax? 30%. And value of the firm you have computed here, 26,50,000. Can you see this? 26,50,000. So multiply by 100 once you get the answer.
19.81%.
Around 19.8% right on approximately. This is a shortcut way. Otherwise you can prepare a table, source, amount, weight, cost, weight into cost. You can see in the study material, institute have prepared a table to reach that answer. The final answer is 19.8%. Okay. So there is one more line in the question. What is that one more line? Comment on it. So what is the effect of this restructuring? Write down comment. Comment, write down. So what is your comment? What happened to KE? KE, which was 21%, has become 21.98%. But what happened to KO? KO, which was also 21%, has reduced to 19.8% because of use of debt, which is cheaper than equity. Okay, so write down cost of equity has increased from 21% to 21.98%. And second comment, write down KO has decreased from 21% to 19.8% due to use of cheaper debt. Debt is cheaper than equity because debt was available at 15% rate of interest. So if you increase proportion of debt, average will fall. Average will fall. Okay. Any query on any question we have done today? No. Okay. So come to question number 17. So first we'll take a small break.